Now, if you're anything like most investors, myself included, you have a majority of your holdings in the US or Europe exclusively. You know, the S&P 500, the Nasdaq, the FTSE 100, the FANG stocks, Apple, Tesla, Microsoft, the companies we all know and love. But in case you've missed it, there's something big happening in the East, and it's been happening for a while. The rise of China and the Chinese stock market. And at this point, as a pragmatic and open-minded investor, I think you are forced to at least have a look at what's going on over there. Welcome back to another video. Today we're covering China and the Chinese stock market. Very exciting things. Nothing political here, just numbers. So drop a comment with your favorite Chinese company or ETF. Hit the like button, subscribe, drop a comment if you have any questions. And as always, there will be timestamps in the video, and let's get to them. China is currently the world's second largest economy with about 14.3 trillion in annual GDP, so gross domestic product, which is basically the revenue of China. And they're about 7 trillion behind the US's 21.4. But in terms of spending power, so how much they're able to buy in terms of goods from other countries, China is the largest one with 27 trillion in purchasing power versus the US's 21.4. So the giants from the East definitely exerts as much, if not more, economic power than the United States. And with a higher GDP growth and about 1.3 billion people, which is also growing faster than the US's population, the gap between US and China is expected to close in over time, but maybe not as fast as previously expected. Now, a massive economy is all well and good, but the most important thing for me as an investor is the stock market and the publicly traded companies, so the really big ones. And in later years, China has become more and more of a topic as Huawei is becoming a staple tech company across the world. Alibaba is now the world's largest retailer, and companies like XPeng and NIO are expanding globally with their electric vehicles. So investors and customers alike are talking more and more about the Chinese companies as a result of their international expansion. Now, despite this global expansion, the Hang Seng Index, which is China's Dow Jones Index, has been wildly inconsistent and has truly struggled finding its footing after the financial crisis in 2007. And the index is actually currently sitting at its 2007 level. So it's been flat over 13 years. So if you've been invested in China, you've pretty much missed out on the greatest bull run in history. And in the same time period, the S&P 500 has surged 350%. However, the Chinese giant tech companies have been a bright spot. And since its launch, the K-Web ETF, which is Crane Shares Chinese Tech ETF, is up more than 150% since 2013. And this one has companies like Alibaba, Netease, Tencent, and Baidu, which again are expanding globally and especially in Asia. So tech has been a bright spot for investors over in China. And despite heightened tension with the US and the ongoing trade war, the Chinese companies are still eyeing expansion globally, especially in Europe, where they are doing quite well with strong marketing and high quality tech. And I think international customers are coming more and more acquaintance with Chinese products and are willing to give them a chance, and they might even be seen as a breath of fresh air from all the big US tech companies. And China's reputation as a mass producer of low quality products is slowly fading away as high quality consumer electronics and electric cars are invading the international markets. So I think China is slowly changing the reputation and becoming a player on par with the US, Germany, and Japan as far as when it comes to how they're viewed with international customers in terms of quality, for example. Now, unfortunately, most larger Chinese companies are either privately held, state-owned, or listed on the Shanghai Stock Exchange or Hong Kong, which most international investors don't have access to. But there are a huge amount of Chinese companies available as ADRs and over-the-counter stocks in the US. And despite recent talks of delisting, I think things will iron themselves out, and you'll still be able to invest in companies through the US stock market. And some of the biggest Chinese companies are actually listed in the US, but they're also listed in Hong Kong or Shanghai. So companies like Alibaba, JD.com, PetroChina, Pinduoduo, China Life Insurance, Netease, and Baidu. And just Alibaba, Baidu, JD.com, and Netflix is the big four tech giants of China. So the same as the FANG stocks over in the US. And these are expanding globally very, very quick. So you do have access to the companies that are, in my opinion, the most exciting. So I don't think international investors are missing out on that much. Many young investors actually hold one or more Chinese stocks in their portfolio, and companies like Alibaba, Baidu, and Neo are constantly making the top lists of Robinhood users and millennials investors' portfolio. And I think this is great for the world economy and the stock market. Competition is always welcomed, and it's only fair that the big US tech companies finally have to fight for investors' money. So it was about time someone stepped up to the likes of Google, Amazon, Facebook, and Netflix. And there are actually 145 Chinese companies listed in the US as over-the-counter stocks or ADRs. And you can find a great list over at topforeignstocks.com. What a website. Wish I had that domain. Now, these are not traded as regular stocks. Now, ADR stocks are actually certificates that represents an amount of shares of, let's say, an overseas company. So if you buy Alibaba shares in the US, you only have a certificate that represents ownership in the equivalent amount of shares where it's actually listed. And over the counter means that a stock is traded among traders, a trader's network instead of a centralized exchange. So although it's pretty much the same, the price mirrors the actual stock, it is slightly riskier. And I personally stick to just going along regular stocks because it allows me to sleep safe at night, and you don't have to be worried about all the talks of delisting and the trade war. But that said, I don't think you should shy away from over-the-counter stocks or ADRs. But again, I'm not personally recommending them. I'm just saying they're not as risky as some people will have them to be. So some of the most popular and interesting Chinese companies, in my opinion, are as follows. I'm not recommending them personally, just a list for you to take a look at. Alibaba, huge e-commerce and cloud player. Tencent, a massive holding company doing social networks, music, e-commerce, internet service, payment system, and gaming. Did you know, for example, that they own Epic Studios that makes Fortnite and Riot Games that makes League of Legends? And they also have Grinding Gear Games, which makes Path of Exile. So they're huge in gaming. JD.com, huge e-commerce player. Neo, which obviously make electric vehicles, very competitive, great cars. Tencent Music Entertainment, I think it stands for, TME, which is a music streaming platform. CTO, Shipping and Logistics, can be a great play for the growing e-commerce business in China. Baidu, search engine and advertising, they're sort of China's Google. Then you have Blibli, which is a video sharing website, probably butchered that name. Weibo, which is a big blogging site, kind of. Netease is another tech giant. They're involved in advertising, gaming, email services, and e-commerce platforms. They're quite foggy, some of these big tech giants, and they are way more diversified than Facebook and Google, and they can be quite difficult to actually track down and find out what they do, but these are just the main categories. Baozun is an e-commerce platform solutions. Again, could be a great picks and shovels play. Pinduoduo, e-commerce and marketplace. Once again, very difficult to distinguish these different e-commerce platforms. And then Luckin Coffee, controversial names at this time, but it's sort of the Starbucks of China, I guess. So those are some of the more interesting ones. Now, this list of companies is quite popular with international investors, most likely because it's tech and e-commerce heavy. And given the huge population and population growth in China, there's no wonder there are so much interest in these particular names. But of course, you have more traditional companies listed in the US, such as the big ones like PetroChina, China Mobile, Bank of China, China Life Insurance, TAL Educational Group, China Eastern Airline Corp, Aluminium Corp of China, Sina Corporation, and so on, if that's your cup of tea. But I think unless you live in China or you have an inside knowledge of the economy, I would probably be careful going into these semi-state run big traditional businesses like oil and banks, because I'm not sure how heavily tied they are to the government. And I personally don't want to invest in a company that I feel is tied down by the government. But I guess most companies in China are to some extent. So I find these huge national players difficult to analyze, and I wouldn't personally invest. Now, if you find the Chinese economy and the list of companies difficult to navigate, and you've no clue who's who in China, or which companies are in bed with the government, or what their plans for global expansions are, most investors find difficult to find out about, you can actually go with ETFs, or exchange traded funds. And there are quite a few of them, but these are the big, broad ones that I found. And these are actually decent ETFs to hold. So you have FXI, which has a 0.74% expense ratio. It's heaviest in financials. Then you have GXC, 0.59% expense ratio, tech heavy, probably the one I would go with, or KWEB, which is Crane Shares China Tech. And then you have GLCN, which is 0.50 expense ratio, so the cheapest one of the three, but this one is consumer staples heavy. Maybe not the most exciting category over in China. Some minor, more specialized ETFs. You have Chinese small cap, HAO, 0.75% expense ratio, has a very high dividend of 3%. Then you have KWEB, which is the Crane Shares China Tech ETF, 0.76. These ETFs are very expensive. This one is tech heavy, so you do get more growth there. China Consumer Staples, CHIQ, 0.65, not too bad. Holds companies like Meituan, JD.com, Alibaba, Pinduoduo, Neo, etc. So you do get a lot of e-commerce in this one. China Financials, CHIX, 0.66% expense ratio, 3.6% dividend yield. And then you have China, another China Tech, as CQQQ, 0.70%, very tech heavy. So I would probably stick with either KWEB or CQQQ. Now, of course, always consider an ETF's expense ratio, underlying index and how well it tracks it, inflows and outflows, and liquidity before investing. For most investors, ETFs will be the best choice. No need to worry about trade wars, delistings, drama over in China. If you just believe in China and the Chinese growth story and its potential global expansion, you can just invest in its economy with one click and never have to worry about it and get a sweet dividend on top. Now, if I had to grab a Chinese stock, I would probably go with one of the big tech names. So Alibaba, Tencent, Baidu, Netease, or KWEB. They look similar to the big US tech giants, and I think they will thrive in 2021 and beyond as the web, cloud, streaming, social media, and e-commerce grows in Asia, but not least in Southeast Asia and the whole region of Asia. And if anyone is going to take market share there, it's going to be the Chinese companies. So I truly think they will dominate the eastern half of the globe, but I still don't see them cracking the international market, at least in terms of software. I think that's where Google and Microsoft and Amazon really shines. But in terms of hardware, cars, consumer staples, I think China has a good shot. I've owned Alibaba in the past, but I ended up selling it because I didn't feel like the stock reflected how well the company was doing whatsoever. It was just trading up and down based on whatever the US and China were doing geopolitically in any given month, and I got tired of it. So leave me a comment with your favorite Chinese stock. Give me a topic for next video. And as always, I'll see you guys in that one. See ya.